It's a pleasure to be here with such an amazing panel of experts from leading investment firms. Today's session is about to understanding the Euro's role in a fast-changing global market, what's driving the challenges, where the opportunities are, and how investors can best respond. So let me introduce our speakers. First, we have Damien Mariette, portfolio manager at CPR Asset Management, part of Amundi Group. Then we have Brian Hall, portfolio manager within the European equity team at BlackRock. Benjamin Conquet, fixed income and multi-asset product specialist at Amundi Rothschild. And Ben Stapley, managing director and portfolio manager for long-only and long-short strategies at JP Morgan Asset Management. Thank you all for joining us. And as we have less than 45 minutes, let's dive straight on. I'd like to start with a big picture now. For the past decade, investing was characterized by low interest rates and stable globalization. Today, the environment has changed a lot. We face persisting inflation, we face higher rates and greater geopolitical fragmentation. So my first question for every one of you is, in this new world, more complex, what do you see as the biggest challenge or risk that investors are facing? We can start first with Damien.
So we have been through a difficult period over the past year. Recent events have revealed Europe's vulnerabilities by highlighting and exacerbating external dependencies in key sectors. So everyone had in mind health with the pandemic. So mask wasn't mandatory. It's good because we don't have one. When we have one, it was mandatory. So we have seen how much dependent we are in regard of materials, services, and product. That are now laid bare, so we have to act. But we still are in a challenging environment, so we are being put into pressure by our allies. The U.S. administration put pressure on Europe for defense spending, for example. So we are still in a challenging environment where the place of Europe is a quick question, and we have to act to finally be able to find our place.
Brian, what's your point?
Yeah, I would agree that the political environment is challenging, but I would point it to a different area and say that in Europe we need to have a stronger investing culture rather than saving. There's a lot of wealth sitting in European households, but it's in fairly unproductive assets sitting in money market funds, for instance, and we have very high savings ratios today across Europe. Either concerned about this or that or the other. But we need to improve the culture of investing across Europe to create wealth over time, lower the cost of capital, and to open up opportunities for the future growth of European companies.
Thank you. And Benjamin, what's your point of view?
Well, let's shy away from the foreign policy and how the US are going to tackle Russia, Ukraine, China, Taiwan. Because this we're just witnessing and there's nothing we can do. Though, if you look at US, what we're missing is hard data now because we've been having a long shutdown for 40 days or so. So we don't have NFPs. We don't know the current state of the US job market. So what we need to look at is how far the softening of the labor market is going to the US. We don't think there's going to be a recession, but if there is a recession, since many asset classes are screening expensive currently, you might want to do a defensive allocation. So that's the first point you want to look at. But we think the Fed is going to keep on cutting rates in the first quarter, even if December is not really done in the first quarter. That's for the worldwide investor. For the European investor, there are two things that we need to look at. One is Germany and the other one is France. Germany is, are we going to be able as European citizens to muscle up and have a true defense spending on infrastructure, on common defense, and how is this going to have an impact on long-term rates? So that's the first news. The second news is how the French are going to be able to reform themselves. And put it in the simple words, what we'd like to have is Germany spend more, French spend less. Unfortunately, we're not sure this is going to go that way. So this is the tickles that you want to look at in here, how the French are trying to be spending less, while we know they're not going to be spending less. How Germany is going to be able to take the torch and building a stronger Europe.
Okay, finally, Ben, what's the point of it?
So I think this question itself that's been posed is very revealing. I mean, every conversation we have on Europe starts with what are the risks? And that in itself suggests to me that investors are somewhat overly fearful about Europe. And, you know, we think Europe's ability to withstand some of the crises that people have already mentioned is underappreciated. We actually run European core strategies that have outperformed the US, the S&P 500, over 5 years since the Pfizer vaccine, and also over 3.5 years since Russia invaded Ukraine. So I think perhaps the biggest risk for investors is being too fearful and under-allocating to Europe.
Mm-hmm. Now, talking about opportunities, a big theme in Europe is the drought transition, going green and going digital at the same time. This requires trillions of investments. How do you see this investment megatrend creating specific opportunities for your asset class over the next 5 years? Let's start with Ben this time and do the reverse order.
Great. I mean, when talking about any thematic, I really like to draw a distinction between the top-down and the bottom-up. So no doubt, some of these thematics, I mean, I'd throw German fiscal spending in there as well, are going to be incredible for Europe. They're going to be like really amazing top-down. But bottom-up, they can really create both winners and losers. So as a portfolio manager, it's important to find those underappreciated beneficiaries of the thematics. And just to illustrate that point, if you were to have invested in European telcos in March of 2000, over 25 years ago, you'd still wouldn't have broken even on that trade. You'd still be 20% underwater. So just showing you there will be winners and losers created.
Benjamin?
These guys are on an equity side. I'm the only one sitting on the bottom of the balance sheet side. So my view is going to be likely a little bit different. If you look at the financing of the transition and the electrification needs, loads of it is already done on a daily basis. You have monsters like Iberdrola, EDF, NL, issuing hybrid bonds by 750 million, 1 billion tranche to develop the electrification capacity. Now, the digitalization is another issue, because the digitalization so far was an equity finance business, and we've seen this mega bonds issued by Oracle and Meta, but that is fairly new. We're talking 30 billion issued by Oracle and another 1,000 billion by Meta. But what you have to bear in mind, US investment grade size is $7 trillion. So loads of the PM I talked to at Rothschild, the equity PM, are really worried about, oh my God, how is this going to impact the financing scenario? But so far it's super tiny as opposed to the widespread range of debt that you can raise and you can see in the different corporate bond environment. So for the moment, what is going to change is how the investor is going to tackle that. Because as soon as you finance through bonds, you're going to have a different set of investors looking at, when is my cash back? The time frame for the equity investor is not always the same as the time frame for the bond investor. If you start to finance with bond, then you're going to have people looking quarter by quarter, when is my cash back? So that's going to be tiny difference.
Interesting. Brian?
Well, I think it's positive, first of all, that we are back in an environment in which CapEx is being rewarded possibly by equity shareholders. If you look at the period post-GFC, probably went for a decade when CapEx was a dirty word, and it was more just give me your money back through share buybacks. So I think it's positive that CapEx is being put to productive use. Looking across the equity landscape in Europe, there are several areas where you can choose to benefit from that. And I think the CapEx uptrend that we have now started before all these headlines were coming out about AI going to 5 trillion, 6 trillion, whatever it is, because COVID showed us that we were too reliant on one part of the world for our production. So we had to do reshoring, reindustrialization, etc. For a European investor, we don't have the option of investing in the hyperscaler, but we can adopt the picks and shovels approach, and the companies that are providing essential architecture to a data center, whether that's the electrical equipment, the cooling, or just the nuts and bolts of the construction itself. But we also see governments investing. It's not just Germany. We do see infrastructure being used as a tool throughout Europe. I think the CapEx theme is broader than just the AI, and it's a good environment for us.
Okay, thank you. And Damien?
Yeah, so the European sovereignty push is driven by politics, public funding, and real market opportunity. The pandemic and the war in Ukraine shows us how dependent we are, and so it's led the European prompt large multi-year program to respond to that. You have in mind the CHIP Act, the Rearm Europe, the energy, the energy plan, the readiness 2030, etc. So there are many plans and new rules also. The cyber resilience, the industrial incentive, all of that backed by the Mario Draghi report saying that we need to rethink about our industrial strategy, meaning that we have to invest into our industry. So these actions are clear, sustained demand, and we have also reduced execution risk by the fact that we have help coming from government. So we have everything that long-term investors are looking for a thematic, and we have also in European valuation which are still, even if we are a little bit above our average, we are still in a period where we think valuation are good.
Okay, thank you all for those insights. Let's now move to more focused questions based on your expertise. First, I would like to start with you, Damien. You launched a specific European Strategic Autonomy Fund a couple of years ago. This is a new theme for many investors. Can you explain the long-term structural case for this theme and why it is more than just a short-term reaction to geopolitics?
So, two questions. So, the first question regarding the long-term structural case for this theme. So, it's a theme that we have been hearing all about the news. It's a theme that is gaining momentum this year, and especially in regard of the defense spending. But it's something that has been highlighted by the recent crisis I mentioned earlier. So it shows us how dependent we are, and we have no other choice than to act. What is important is the concept of the European strategic autonomy have evolved through time. So it's referred normally to the Europe ability to act autonomously. So it was firstly linked to defense matter. It's now linked to Europe dependencies, so economic, industry, finance, technology, etc. So it's really important. What is the long-term structural case? If I take the example of the sanitary crisis and the pandemic, and the fact that we have seen that we are not able to have masks in the beginning, we see how dependent we are now in regard of respiratory equipment in hospital. We have taken action. And for example, here in Spain, this year, you have started a plan for the next 4 years, 9 billion investment to increase medicine capacity in Spain, because in Spain and in other countries in Europe, we are facing dependencies on medicines. So I don't know if you have that in mind, but 80% of the active principles used in medicine is produced outside Europe. Meaning that for us, we have hundreds of medicines that are non-available during the year. So we have all the example of the paracetamol, of amoxicillin, but there are also other medicines that are not available, and we have to invest into our industry. We have to reshore a capability in Europe to be sure that we can reduce these dependencies and to reduce this non-availability through the year. So we are just starting to invest, meaning that we have in front of us at least a decade of investment for this thematic. And you say, you asked the second question, is just not a short-term answer to geopolitics. Geopolitics is in fact something that we have to accept, and we have to thank the U.S. administration. Because it's because of Donald Trump and his administration, then the U.S. opened his eyes. You know, it's a wake-up call we are waiting for many years to act and to say, okay, our past allies are not so much, we cannot so much rely on them that we were able to do a few years ago. So we have to invest in ourselves. We have to invest into our industry. So and I will use the defense example. So we are in front of us a decade at least of increasing investment in defense to be sure that we will be able to respond to any threats if a threat happen. But the market is a little scary about defense. If we have a ceasefire, we have market is expecting that the increasing defense spending in defense will stop. Just take the example of the ammunition stockpile we have in Europe. We are currently at 2 million of the basic ammunition. We need, if we follow the NATO rule, we need 33 billion of stockpiles, ammunition stockpile. We are currently only 2 million of that. If we have a ceasefire next year in Ukraine, it will still need 14 years to build this stockpile. So, as I mentioned again, we are in front of us at least 1 decade, maybe more than 1 decade of investment to respond to the threat and to be able to regain our independence in some specific sectors.
Okay. And looking beyond the defense or medicine theme that you have mentioned, what is the one emerging theme in Europe that you believe it will be critical for investors to look at in the next 5 years, for example?
Yeah. So there are many. In fact, when we are talking about this European strategic autonomy, we are talking about multi-thematics. We are talking about multi-mega trends. So defense is one of them. We need to rearm Europe. So it was mentioned by my colleague. We have Germany, which are willing to invest more, and it's great to spend more. They want to spend 500 million in defense over the next 5 years to increase their spending to reach the top 3.5% of GDP, which is now the new NATO target. So they are currently spending less than around 2%. It means that in 4 years, they will spend 160 billion per year in defense. So that is clearly one area where we are seeing growth coming from the years to come. And we have also in the second main mega trend for me is everything related to the reshoring of activities in Europe, linked to also to the capex spending plan of many companies in Europe. We have in Europe to change our way of thinking of the industry. We have to reshape our future, and we have to think about a new industrial strategy, meaning that we need to invest. So, for example, you talk about AI. Europe has put in place a 200 billion dedicated to AI, 20 billion already dedicated to the building of Gigafactory. So we are putting in place in Europe big investment plan to support investment, to be sure that we will be able in the future to reduce our dependencies. So for me, the most two important thematics for the next 5 years is related to defense and related to the reshoring of Europe.
Mm-hmm. Thank you, Damien. And moving to Brian, let's look at the income decision. In a world where fixed income now offers higher yields, many investors are rethinking the role of equities. Could you please explain the benefits of dividend growth and how it helps investors to preserve purchasing power and fight inflation over the long term?
Yeah, sure, happy to. Well, that's really the starting point for why you invest in equities in the first place, that you own the share in a business that you expect to grow over time. And if you select the companies with the strong fundamentals, then those cash flows will grow at a rate that beats inflation. And obviously, we've had a period of rising inflation for the last 5 years post-COVID. And equities have, even in Europe, as Ben mentioned, some have beaten the US. We've had double-digit total annual returns for equities the last 5 years. So when you invest in Europe, dividends are a key component of what you expect to earn on an annual basis. And over the long period, we kind of think of dividends being about a third of your total return. That's what historically it has been and how we think of it going forward. And that's as we see, on average, European companies pay 40 to 50% of their net income out to shareholders, principally through dividends. And I think that we have seen an improved dividend culture from European companies, that they appreciate that shareholders and investors prefer a steadily rising dividend as opposed to one that is volatile. So good year, good dividend, followed by a bad year, bad dividend. We much prefer, we advocate companies to follow a progressive dividend profile that can keep ahead of inflation. And they can use buybacks if they have excess capital to make a supernormal return. Now that's the average, and there's obviously companies who are growing faster, who use their cash flows to invest in capex or to buy other companies, and there are companies that are more mature and would have a higher payout ratio. So when we're constructing income portfolios in Europe, we like to take a blend of companies which are more mature, which have those high dividend yields stay, together with companies that can compound their dividends over a long period of times, and occasionally some with some faster growth. And by doing that, I mean that's essentially mixing a pay me now structure with a pay me later structure. And if you construct the portfolio in that way, you can arrive at a portfolio that does pay a premium to the market and should be expected to grow over time. So we are obviously strong advocates of equity income investing as part of inflation protecting your assets.
Okay, thank you. And we also heard that European market is cheap, and as a fundamental equity manager, what are specific qualities or sectors do you look for to distinguish real opportunities from value traps in the current market?
Sure. So when you're screening for value, whether it's price to earnings or dividend yield or whatever metric, you need to be aware of the extremes. So if you were to take all the equities and rank them 1 to 100, where 100 is the cheapest, I would advise that anything above 90 is probably a bit too dangerous. It's cheap for a reason, it's too good to be true, or it's that classic value trap. That's what I mean by value trap. Well, they normally have characteristics of having a poor balance sheet, so too much debt, insufficient free cash flow to repair that balance sheet organically, so they might need to come back for more from shareholders. Their return on capital employed will be below the cost of capital employed, and these could be stemming from structural problems with their revenues or an emergence of a new competitor that just structurally changes the way they create wealth. So we would avoid the very cheapest. And personally, I don't place so much emphasis on asset values, so kind of traditional price to book for many sectors, because that asset has to demonstrate that it can make a return. If you can have a stranded asset that isn't making any cash flow. So any valuation metric on value needs to be set against the fundamentals and where you see the profitability going. So we would always look at the cash flow and the return on capital employed, comparing what the market is telling you today about the value of that business, whether it's sales, capital employed, assets, and where you think there's an opportunity over a medium-term time frame, and I would say 3 years is good enough, to think where there is a gap between what the market is telling you and what you believe. And if you can find those gaps, those are the bargains, and just avoid the companies which have fundamental flaws in their wealth generation capability.
Mm-hmm. Okay, thank you, Brian. And now moving to fixed income, Benjamin. Over the last decade, fixed income primarily play a defensive role in a portfolio, but they now offer real income. So how should investors in this room or advisors think about the new role of fixed income in order to build a balanced portfolio?
So how bonds play a defensive role, basically. Arguably, you could say they haven't played a defensive role for a long time. Up until 22, negative yield, blah, blah, blah. Everybody's shying away from the asset class. 23, 24, 25 was not a defensive role. It was a beta play. Whatever you bought in credit, whether the investment grade, high yield, emerging, sub-debt, you had amazing years. Mm-hmm. Sometimes double-digit return, which is, for fixed income, extraordinary in the true sense of the word, not normal. Now, where are we now? I'd be crazy if I told you that the opportunity of the screaming buying opportunity is still here. No, spreads are fairly tight. Whether you look at IG, high yield, sub-debt, bank CoCos, you are rather on the average down. So are US equities, very, very expensive. So are some part of the European equity, sometimes quite expensive. So when you do an asset allocation, basically you are acting as, what am I trying to gain? What is my gaining expectation? I fear that today, with the current levels, the main question is also, what am I ready to lose? And that's where bonds is actually coming into play. Because today, even though spreads are tied to coupon, as opposed to what Brian was mentioning, you want as much as possible company committed to stable dividend. My coupon is fixed. Whatever they say, I'm going to get it every year. Although there's a default, unless there's a default. So I can still buy a portfolio, a safely portfolio, half triple B, i.e. good signatures, half double B, the high end, the high yield, paying out 4% with an approximate duration of 3. These 4%, 2.5 risk-free rate, 1.5 a credit premium. Yeah. Right? So this 4% I get in, year out. And let's do a stress test scenario. I go into a deep recession. I doubled my credit premium. So I move from 1.5 credit premium to 3, which translates 150 for triple Bs, 300 for double Bs. For people who know crossover, it means crossover in the 500 basis point to 600 basis point scenario. That's high recession environment. If you have that and mitigated by 50 basis point in risk-free rate, you basically have a 1% up in yield, which is 3 to 4% loss, while you make 4% carry. So your risk scenario is, am I going to make money, huge money? No. Am I going to lose money? That's very unlikely. And if you go into full high yield, which is double Bs and single Bs, you can get a portfolio with 550, 5.8 coupon with a 3 duration as well. And even though you double the spreads, they go to 600 basis point, what are you going to lose? Because you get this 6% coming in every year. What are you going to lose? You can lose up to 3% net of fees maximum, while it is very likely you're going to go 5 to 6. So from a allocation point of view, we really love that risk reward. Very likely 4 to 6, depending on where you invest your eggs in terms of ratings. Very unlikely -1 to -2. And that's the beauty of fixed income currently, because your carry is here to protect you. The cushion of the coupon is actually good enough to sustain a lot of bad news in spread widening.
Okay, and you have mentioned the stress test, and given that higher interest rates can lead to increased corporate defaults, how does your team at Edmond de Rothschild analyze this credit risk? And are you finding attractive opportunities on European credit markets right now?
Well, yeah, rate can play a role in terms of ability of companies to refinance themselves. But the main issue is the growth environment. What we don't like as bondholder is a recession. Basically, companies not able to repay the debt. Currently, where are we? We have a really tepid growth. The macro environment is 1 to 1.5 growth, and we're really happy about that. As a bondholder, you couldn't see me smiling more. My fellow here, as equity manager, they usually like EPS to grow. I couldn't care less. For me, it's second order. I invest in bond. I do the banker. My only issue, my cash backing. So if the cash flow is stable, I smile like a banana. Okay, so for me, the macro environment where I have 1% growth, I'm happy with it. I'm super happy with it. And this is what we have. So what we need to pay attention is how the US is going to react, as I was saying earlier on. And it's very binary. At the end of the day, if I do the bank lending money, if my company is able to refinance itself and push back the maturity bond, the maturity loan, I have no issue. And what happened in the European high yield market over the last 2 years, 400 billion of debt outstanding. 24 was 90 billion of primary, 25 already 100 billion of primary. So half of the market, which was supposed to mature in 25, 26, 27, has refinanced in 30, 31, 32. What does it mean? My default risk is coming down. I have refinanced my debt and I've repaid my earlier tranche. My default risk is coming down. So yes, there are several points of scrutiny, which is recession lending standards, of course, and we all see what direct lending has done in the States. So is there going to be a wave in Europe? We don't think so, because it's way, way, way tiny here in Europe. But in terms of credit, you can actually build some portfolio yielding 4 to 5%. And what we really push for our clients here, because we know there are question marks in the environment, is go short duration, build a portfolio of short-dated bonds, 0 to 1, 1 to 2, 2 to 3, 2 to 4. If you do so, you have a portfolio mixing IG and high yield. You have a portfolio paying you at 4% a year with a duration of 1.5. And the duration being this little bugs that amplify the mark-to-market volatility. If you have movement of 2 in rates, it's not enough to wipe out your carry. See, and that's even more true in the context of your term deposit paying you 175 to 220, depending on the bank where you are. So you have a opportunity cost of not being invested in credit for something which is super safe. So short-term investment are more defensive. For the guys who actually like the steepness of the curve, target dated fund is still very much in here. And I know in Spain, we've raised a lot on our millesima franchise. So thank you very much at all for your loyalty. And we've raised 900 million in one fund in 12 months in target dated. And the little brother is coming soon. So that's we'll keep you posted. And for the people who are actually a rating constraint, because that do happen, we really like the subordinated bond from Empresas, Bonos Híbridos, because you have de facto a nice premium for something which is a little bit more complex with call dates, but you stick to investment grade default risk. And that pays you, again, 4 to 4.5 for a duration of 3. As far as the mix is absolutely perfect, because you don't want to go 10-year government bond where you have a duration of 6 and you have fiscal uncertainties in terms of spending plan. Is it going to happen? To what extent? So any move you have in 10 years to 30 years, you multiply by 7 or 15. So you can wipe out a lot of the 2.5 you get on 10-year German bond. In credit, you go shorter and you have extra carry. That's the beauty of it.
Thank you, Benjamin, for your interesting insights. And now moving to Ben, from your global perspective, what makes the investment case of Europe company right now? And do you see in this region that you don't see elsewhere in the world?
Yeah, so I mean, I can answer this question about Europe and what it brings really in one word, and that's diversification.
Yeah.
I mean, I'm sure everybody in the room knows that year to date, Europe has outperformed the US in US dollar terms by double-digit percentage. So that's got the attention of the diversification benefits, particularly for investors that are over-allocated to the US and in particular US growth. And ultimately, Europe doesn't look like the US. It looks very, very different, and that's really good if you want diversification. So Europe has about double the amount of financials compared to the US, but it's only got 1/3 of the tech. Mm-hmm. And for the last few years, that's been framed as inferior. Having financials and not having tech has been seen as bad. And you can kind of understand that. If we look at the Mag 7 over the past 5 years, so just after the Pfizer vaccine, the Mag 7 has returned 215%. Now that's quite impressive. But then I'm going to tell you that European banks have returned 400%. So almost double the Mag 7. So that shows you that Europe brings something different and it brings diversification.
And drawing on your expertise in long-short investing, what unique edge does a long-short approach offer in a current highly dispersed European market that advisors simply cannot find using a traditional long-only approach?
Yeah, so we really believe in the power of shorting. We believe it can expand your alpha set as an equity investor, and it can also allow you to use your risk budget more effectively and better control risk. And one reason for that is benchmark concentration. So even in Europe, which doesn't have a concentration problem really versus other regions, if I look at the MSCI Europe, there's 400 companies there. Mm-hmm. Only 20 of them have 1% index weight or higher. And there's about 800 perfectly investable liquid companies in Europe that aren't even in the benchmark. There's zero weighting. So if you're a long-only manager and you want to express your positive and negative views, both make you alpha, if you find a company you don't like, you better hope it's one of those 20 with a 1% index weight. Otherwise, you're not making any alpha from that decision. If you introduce shorting, and we run active extension products, or you might have heard them called 130-30. So we short 30%, recycle those proceeds into the long, so we get 130 long, 30 short. It's 100% net core European exposure. But once I've got that shorting budget, those 20 stocks that a long-only investor can get a 1% underweight in becomes 400 stocks in our strategy, because we can borrow those shares and sell them. That's a game changer, because now we can properly reflect our views, positive and negative, in the portfolio. And I've now got 400 companies that I can use to offset risks that may have been developing elsewhere in the portfolio. So, we're big believers in long-short investing and adding active extension to long-only. We think it expands the opportunity set and really opens the door to great alpha in Europe and superior risk control.
Okay, thank you, Brent. Thank you all for your insights. We've covered a lot of ground, from fixed income to equities, from structural challenges to thematic and strategic opportunities. As a closing thought, I would like to ask each of you for one brief takeaway for our audience. What's the single most important piece of advice you would like to give them to build the European portfolio for 2026? We can start with Damien first.
Yeah. So we can no longer use yesterday's solution, because it's precisely this habit that led to the situation we are facing in terms of dependencies and vulnerabilities. So the public spending has showed us the way. So they are targeting sectors, industry, to help and to reshape the future of Europe. But it won't be enough. We need the private money also to be involved in that area. So we need private and public money to be sure that we are able to reshape the future of Europe. And as European, I think it's our duty to do that.
Okay. And Brian?
Keep it simple, stay invested, believe in Europe, and stay diversified.
Okay, thank you. Benjamin?
Well, on my side, I don't have the upside of these guys. Can't deliver 20% there. So I don't have the upside. That's fine. Everybody understands. So I want to make sure I don't have the downside.
Right.
So if you invest in credit bonds, just make sure your manager is super diversified, because shit can happen, and you need to have a portfolio that is diversified enough to sustain a single or two credit loss. So when it comes to target dated fund, we have 150 lines of portfolio, 0.8% on average, so that we get the carry, where you diversify the portfolio to make sure that the downside is protected as well.
Okay. And Ben?
And I'd call out just two things for investors not to be fearful about, not be overly fearful about. The first is Europe. Now, this is a massive opportunity here in Europe. You've heard some good examples today. And don't be fearful about shorting as well. Funds that can short are not more risky. They open the opportunity set, both from alpha and a risk perspective.
Okay. Thanks. Thank you once again to our speakers for your interesting insights, for sharing your thoughts. And thanks also to the audience for joining us today. And I hope this discussion provided practical ideas and create a sense of where the next opportunities lie in Europe. Hope you enjoyed the rest of the event. Thank you so much. Thank you so much.
Insert.